Welcome and thank you for standing by. Currently, all participants are in a listen-only mode. Today's webinar is being recorded, and the recording will be posted publicly. If you have any objections, you may disconnect at this time. Now I'd like to turn the call over to your host for today, Bryce Hannibal.
Hello, everyone. Thank you for joining us. Welcome to the FSRDC presentation series. I'm pleased to have our speaker today. We're going to run through a few announcements before I turn it over to him. We'll start with the disclaimer. I'll just go ahead and read that. The FSRDC presentation series offers a virtual platform for researchers who have conducted research in an FSRDC using Census Bureau data to share their work. Though the Census Bureau received a programmatic benefit from this work, the researchers were neither employed nor funded by the U.S. Census Bureau. The Census Bureau and its partner agencies have reviewed the statistical output contained in these publications and presentations to ensure against any unauthorized disclosure of confidential information. However, all findings and interpretations of these research results are made exclusively by the researcher and do not represent the views or positions of the U.S. Census Bureau or our partner agencies or institutions. Okay, so today I am pleased that we have Hyun-Sub Kim, who is a senior economist at the Federal Reserve Bank in Chicago, and he'll be presenting his work titled The Labor Market Impact of Shareholder Power, Worker Level Evidence. We'll give Dr. Kim, well, as much time as he would like, and then we'll have a short Q&A at the end. You should see a chat window. You are free to type in your question along the way, and I will run the Q&A once we get to that point. As always, if you or any of your colleagues or fellow researchers would like to present at the FSRDC presentation series, please reach out to your local RDC administrator and they will put you in touch with me and we can get that set up. So, Dr. Kim, thank you very much for coming, for joining us, and I turn the time over to you.
All right. Thank you so much, Bryce, for a very nice introduction. It's my great pleasure to see all of you, even though I cannot, see you in person, each of you, but I'm very excited to talk about my research based on census data. So let me just start quickly by my own disclaimer. This is my own view. It's not of the Federal Reserve System. Okay. So this is based on my paper, actually a couple of papers. With my collaborators, longtime collaborators by now, Antonio Falato at the Federal Reserve Board, Daniel Goligo, who used to be an RA at the Chicago Fed, and then he's now pursuing PhD at Northwestern, and Till von Achter UCLA. Let me start by motivating the paper using these two trends. So on the left-hand side, starting in 1980 and up to 2014, you see a secular increase in what we call concentration of institutional ownership, okay? So that's part of our research is focusing on. So let me spend 10 seconds to explain what it is. So we look at the average firms on US public markets, such as NYSE, NASDAQ, AMEX, etc. And we look at what is the ownership stake percentage by what we call block institutional ownership. Okay, the data itself is from 13F, what's called the SEC mandatory filing by institutional investors. Our definition is pretty straightforward. We use 5% as a cutoff for any institution owning any public firm more than 5%. We count them and then we go to the next institution for the same firm. So we basically add every institution for a given firm owning more than 5%. And we present the average by year starting in 1980 to 2014. So what you see is that block institutional ownership, or we can call it concentration because it's relatively concentrated stake in publicly traded firms, has increased pretty substantially and almost monotonically in the past 35 years, starting at about 5% in the 80s. And 10 years ago, it reached about 14%. And if you do the same analysis as of last year, for instance, it's been even higher. Okay, so there has been increase in concentration of institutional ownership. And on the labor market side, this is pretty well-known fact by now. So the total wages and even employment has been declining in the US labor market. So in particular, what we present on the right-hand side is the total wage and salary bill at the US aggregate economy level scaled by GDI, domestic gross income. And the ratio used to be around 48% back in 1980. Again, if you fast forward to 2014, it declined to around 42%. So these are two very salient aggregate trends, which have pretty highly negatively correlated, right? And that may or may not suggest there's some causal relationship going on between these two. And in some sense, that's what our paper is trying to get at. So the research question that our paper is getting at is, does concentrated ownership that we just saw on the left-hand side of this figure affect workers' outcomes and ultimately hurt workers, whatever that means, right? And I'll go into details of how we measure, workers' welfare, earnings, etc. But in the background, we believe this is a very important question, yet understudied, mostly due to data limitation, we believe, and that's where the census data set really come into play very, very nicely. So just to give you a little bit of more context, there has been a pretty, I would say, intense debate about what's the goal of the firm. So when I used to teach MBA students at Cornell a few years back, I always start my capital budgeting class saying, oh, the goal of the firm is to maximize the shareholders' value or net present value of the firm as a collection of projects. So that's a very typical prevalent view, at least since 1980s in the US and other developed economies. But if you kind of go back a little bit further back, like in the 70s and even 60s, it wasn't actually obvious that firms are just supposed to maximize shareholder value. So what I show you on the left-hand side again is a New York Times article back in 1970, where there was a campaign GM that was pursuing what's called the social responsibility of firms, while Milt Friedman, well-known supporters of the firms are just supposed to maximize shareholder value, had an op-ed in New York Times saying, no, firms are just maximizing shareholder value. And fast forward again, today, there has been a lot of debate about, should we think about what we call the stakeholder value, including workers, society as a whole, and even environmental issues, versus firms are just supposed to maximize shareholder value. So this kind of tension between shareholder capitalism on one hand versus the stakeholder capitalism on the other hand. So I hope you to keep this question in mind as I go into the details of what we do in this paper, because ultimately that's the economic message that we're trying to get at through this paper. So let me get into a little bit detail about what we do in this paper. So to our knowledge, this paper will be the first to look at the impact of concentrated institutional ownership, and I'll explain why and how concentrated institutional ownership matters for worker level earnings. So the worker level earnings data comes from US Census Bureau LEHD data, longitudinal employment household dynamics data. So I'll explain it in a couple minutes, but the key advantage of this worker level, actually firm worker match data, is that it provides a measure of individual labor income or earnings at the worker level. So we can directly look at workers' welfare, and to the extent that the shocks are coming from firm level, we can also control for worker composition changes. So that's going to be a very, very important advantage of this data set and our research design in general. And another key benefit from using this LH data is that we can actually look at not just average or even median effects of changes in concentrated institutional ownership, but we can also look at a lot of heterogeneity. For example, what are the top CEO or CFO type employees are getting as a result of this change in institutional ownership versus, what about the typical rank and file employees? And that's all possible because of the great granularity offered by the LH data. Now, you may wonder why institutional ownership. So let me briefly tell you why we decide to focus on institutional ownership concentration as opposed to, let's say, individual, including insider like board of directors and CEOs and presidents and so forth. I mean, first off, these days, institutional ownership account for more than 60% of US public firm equity ownership. So that's a majority. So that's quantitatively very important. But perhaps more importantly, or equally importantly, the point is that institutional owners are, because of their fiduciary duty, they are supposed to maximize shareholder returns, while individual or insiders might have some other quote unquote agenda, such as they have their own private benefits and so forth. So we thought that this tension between shareholder value maximization versus stakeholder value question could be better answered by really focusing on institutional ownership, because that's the subset of owners that is going to really focus on maximizing shareholder value. So I'll talk more about that in the next couple of minutes. Very briefly on related work, there has been and there is going to be work on the link between firms, generally speaking, ownership structure and what happens to employees, right? There's a Steve Davis and co-authors paper, very nice, on the impact of PE, and I and Alan Bravin, Wei Zhang has an RFS paper 2015 on activist hedge funds. So you may ask, oh, how is it different from those earlier work? So the key innovation of this paper project is that we really look at the worker level evidence as opposed to firm or what's called the establishment. I mean, for this audience, establishment is things like plants and stores and warehouses, etc. So more of business unit. While if the question is really about workers' welfare, and as I alluded to earlier, and is it very important to control for the changes in worker composition? So we believe that this worker level perspective is quite important, and that's one of the key insights that we gained from this project. And along the lines, I'll later mention, there's a related paper by myself, Antonio, and Till on the concentrated institutional ownership, same kind of similar idea, but we really focus on the establishment level employment. So that's a little bit different question. And at a very broad level, we like to kind of put forward this increased shareholder power measured by concentrated institutional ownership as a plausible explanation for declines in employment and wages in the US economy and generally advanced economy in the past few decades. Okay, so now let me jump into conceptual framework that we rely on and then the actual empirical analysis. So what is our hypothesis? Our hypothesis, is that concentrated institutional shareholders will hurt workers' earnings, generally speaking, workers' welfare, but in this paper, we focus on workers' labor earnings. So the starting point of this framework is this agency theory of the firm, starting with Jensen Meckling, 1976. So it presumes a fundamental rivalry between shareholders and other stakeholders. And in our project, we really focus on workers as one type of stakeholders. So imagine there are limited resources at the firm level, and if shareholders takes bigger share, then workers kind of lose some of their shares and vice versa. So you can kind of think of it as a typical bargaining situation, right? Where if shareholders' bargaining power goes up, then workers lose while shareholders are earning their bigger shares. So you can think of that way as concentration of institutional shareholders increases, for example. That's kind of the variation that we use in our paper. Then workers are losing as a result of the increased bargaining power of the shareholders. So that's one story. And another story, which is not mutually exclusive, is again starting from classical shareholder manager agency conflict. So imagine shareholders, especially institutions, they're solely interested in just maximizing their returns, while managers go along with that value and objective, but they also have some private agenda. So that's what we call the agency conflict. So in this type of situation, when shareholders monitor more strongly of manager, then manager's objective and behavior will get closer to shareholders. So in this case, let's assume that managers somehow like to have bigger employment, workforce, and pay higher wages, perhaps that help them to have better relationship with labor. then once the shareholders get more concentrated, they will monitor strongly of the managers. So those preferences of the managers will be basically pushed back. So they will predict, okay, workers get paid less because now managers cannot really push for their own preferences, and etc. So both of these, as you can see, even though slightly different theoretical framework, both predicts that stronger shareholder power will induce lower workers' earnings in addition to perhaps smaller workforce, which is actually focus of the other paper. Now, very briefly, let me talk about how the concentration of ownership versus dispersed ownership facilitate maximizing shareholder value. So you can think of, it's due to stemming from free rider problem on the shareholder side, meaning let's say I'm a shareholder, but I only own, 0.001%. So even though I like to take some actions, let's say talking to managers and pressure on them, or bargaining hard with the employees, but my cost is too high for the benefit because my ownership is too small, or there's some kind of coordination cost among many investors, but to the extent that those ownership is concentrated among smaller set of investors, then I basically have to coordinate less so that I can pursue my profit maximization goal much more easily. So that's how we think about these, either relaxation of the free rider problems or reduce coordination costs that gives the shareholder power to maximize shareholder value. So that's sort of what we rely on in our as our conceptual framework. Now, we have all these ideas. Now we need the data, right? So we first start with the census LHD. It's based on US state level earnings, unemployment insurance, UI records. So for our project approved by census a few years ago, it has 23 states from 85 Maryland and all the way to 2015. So it provides a pretty long panel, more than at least 15 years of panel data that we can rely on. So the very nice thing about LH data, as you may know, is that it covers almost not 100%, but 95% of jobs in covered states. So you can kind of claim that this is very close to the population of the labor market in those 23 states that is in our data set. And we use, very briefly, two data sets available from LEHD. One is the EHF, Employment History File. That's the key data where we can observe worker firm match, basically job, and it provides information on earnings at the quarterly and annual frequency, industry, county location of the job. And then we also use ICF for control variables such as gender, ages, and education status. Now, with this earnings data from LEHD, I just wanted to just quickly mention that this is a very comprehensive in terms of covering most of the labor earnings. So obviously the gross wages and salaries are basic cash salaries, and then bonuses are there. But some portion of stock options, which could be important for higher level employees or even officers of the firm, and restrict stock options, same story. But as you can see, tips and other gratuities and severance pay, and even some fringe benefits such as meals and lodging and 401k benefits are part of the UI earnings. So it's actually really great for our research question because we're really interested in what is the impact of increased shareholder power on workers' overall welfare in the labor market. So these very great coverages is actually very, very helpful. And on the ownership side, we're kind of following the literature in corporate finance that use SEC, Security Exchange Commission's 13F regulation, where most of the institutions with relatively a mild threshold, something like 100 million assets under management, they have to report to the SEC every quarter about their ownership of public firms, right? So it's also near universal in that sense of the institution ownership, is because most of the sizable institutions and big institutions should be in the data set. So to get at the idea of, okay, concentrated ownership is what we really care about, because that's how these shareholders get power to achieve their goal of maximizing their value. So we decided to focus on what we call the block institutional ownership, which is what I showed you at the very beginning on the left-hand side, right, which has increased in the past 35 years. So the idea is, okay, for a given firm J, we're going to sum all the percentage ownership by any institution that has at least 5% equity ownership for firm J in, let's say year T. So just to give you an example, when we look at actual 13F filing for Kohl's, a department store chain, as of 2011 Q1, their block ownership will be around 21%. Why? Because there are 3 institutions with at least 5% ownership. First is BlackRock 5.4, Capital Research 7.6, and AllianceBernstein 8.1. So once you sum all those 3, that's 21%. So that's how we measure the concentrated institutional ownership. That's a key independent variable that we're going to employ. But let me just quickly say that this is one particular measure of concentrated institutional ownership, but we also, in our paper, we actually did a variety of different checks using, things like top 5 institutional ownership sum, just top number 1, or even Herfindahl index. They give very, very similar results. Now, how do we then take all this data into practice? So we essentially employ difference and differences type approach, but it's not exactly definitive. So let me go into detail. But before I do that, I'd like to emphasize that we exploit so-called big shocks to concentrate institutional ownership, as opposed to, we exploit every single variation in concentrated institutional ownership. So what do I mean by that? So when we think about, this type of difference and differences, we usually think about, okay, there is some kind of treated set of firms and workers, and there is a control set of firms and workers who basically work as a counterfactual in the absence of the, let's say, increase in concentrated institutional ownership. But when we define this treatment and control status, as you can see in these 2 bullets down there, we actually look at relatively big changes in these institutional ownership. For example, to define the treated firms and workers, we look at the firms that compared to the previous year, this year there is at least 5% increase in block institutional ownership, which is what we're using as a measure of concentrated institutional ownership. And similarly, the control group experienced at least 5% increase, but in what we call the overall institutional ownership. So what this overall institutional ownership is that it's not just the sum of all the block equity stakes of a given firm, but it's actually every single institutional ownership who has any stake in a given firm, and we sum everything, right? So for example, for the Kohl's department store I just went over a couple minutes ago, it could be like 60% owned by institutional ownership. So that's going to be the overall institutional ownership. So the idea behind this comparison between treated and control defined this way is that because increase in block institutional ownership typically also involves increase in overall institutional ownership, right? Because, when institutions get concentrated ownership, it's very likely that they also overall increase the institutional ownership. So we like to control for that effect of just the pure increase in level of institutional ownership as opposed to the concentration. So in some sense, you can think of this treatment versus control design, comparison design, as a way to get at a pure concentration of ownership while controlling for the overall level of institutional ownership, which has some effects on, workers' earnings and firms' performance, etc. So we like to control for that. Now, in terms of the actual dependent variable that we're looking at, it is basically annual earnings of a given worker I employed by firm J, and KCT is just industry K, county C, location, and time year T. So focusing on just I and J, firm and worker and firm, excuse me. So we like to look at the next, let's say, firm is treated this year, year 2024. We like to look for next 5 years, starting this year, year 0, okay, next 5 years. What is the sum of your labor income, annual, over the next 5 years, including this year, year 0. So in some sense, it's a cumulative earnings of, 6 years starting this year. But then we like to have some scaled measure so that, you like to have some notion of like percentage change, let's say, in your labor income. So we scale by the average annual earnings of the same worker, like myself or yourself, over the past 4 or 5 years. So essentially, this Y variable, Y, IJ, KCT, is worker I's labor income over the next, let's say, 6 years, but scaled by your previous average annual income over the past 5 years. So compared to that average annual income, how much is your sum of the labor income over the next 6 years? So that's what we call the scaled cumulative earnings over the next 6 years. Okay. And then in our actual regression framework, that's the dependent variable, scale cumulative earnings. And then the key independent variable is really this treatment status. So we're really comparing the earnings trajectory of the treated firm's employees versus the control firm's employees. Okay. I'm going to be very quick on this, but given that this is basically difference in differences, we like to look at whether the data shows some evidence for lack of parallel trends. So one way to test that is naturally to look at pre-trends, meaning before the events, whether there is the earnings of the treated control workers are evolving more or less similarly. So we'll look at that. But another thing that we look at is taking advantage of the stock price data because ultimately market price allow us to think about how the firms are going to be evolving the next few years. So that's a kind of beauty of financial markets data. So for example, perhaps one alternative story might be the tree firm itself is expected to perform worse so that they have to let go more workers and pay low wages. If that's the case, then for instance, the tree firm's valuation might be significantly lower than the control firms. So those things we can actually test ex ante as of today. Okay, so I'll do that. So very briefly on some covariates between treated and control firms. So overall, they are relatively similar in terms of firm size and profitability, as I highlight here. We don't see statistically significant differences in terms of current profits, return on assets, and importantly, the ex ante measure of corporate valuation is actually statistically not different. So that's indication that these firms are ex ante not expect to perform differently as of 1 year before the treatment and control status. Now, what about workers? Again, very briefly, they are very similar. Age is about 42, roughly 6% is male, etc. But one interesting I like to highlight is that the fraction of workers who leave the firm between treated and control here and there is about 40%. So at least from this point of view, workers' probability of leaving the firm doesn't seem to differ. So that's one thing to keep in mind as we interpret the actual results. So let me actually, now these are preambles. Let me get into actual results. So here is the key baseline results. And the basic story will be the increase in shareholder concentration by institutions reduce employee earnings. Okay. So we show a variety of different graphs, as you can see, point estimates and 95% confidence intervals with different layers of fixed effects. So I'm not going to go into the detail in the interest of time, but things are very robust, as you can see, right? So, and the magnitude is also, in some sense, incredibly consistent. It's about negative 0.1. So what does that mean? So that means there is about 10% cumulative earnings loss for the treated workers where their firm experienced an increase in concentration of ownership compared to the control firm's employees, and those control firms did not experience a concentration. So this increase in ownership concentration leads to about 10% decline in earnings over the next 6 years, including year 0. So in a rough sense, if you divide 10% by 6 years, that's about 1.7% wage losses or earnings losses per year. So that's a kind of baseline number that you may want to keep in mind. So the treatment, the concentration of ownership, leads to roughly 1.7% earnings loss. So let's say I was earning $10,000, then basically $10,000 times 1.7%, I lost that. So that's the size of the treatment effects. So it seems to be consistent with our idea that ownership concentration makes the firm's shareholders stronger, and so workers are losing in their labor earnings. Now, we wanted to look at the dynamics a little bit because, first off, there is a pre-trend question whether these things are somehow predictable, and that's one of the key identifying assumption supporting type of evidence. So when we look at the earnings evolution of the same treatment and control firms, 4 years before, T-4, through 1 year before, that's exactly the pre-treatment period. And we see basically pretty precisely estimate zero effect. So there's no earnings changes over this horizon. So we find consistent evidence with the parallel trends. But in terms of the actual post-treatment effects dynamics, so this is what you see in the previous slide in terms of 10% over the next 6 years. But when we look at the first 3 years, that's about half of the magnitudes, which implies that over the course of the 6 years, the losses are predefined equally between the first and the second half. So that's the dynamics. Now, this is kind of getting more interesting as we go into some heterogeneity, right? So the general results of our heterogeneity analysis test will be that the losses are much more concentrated among higher earning employees, meaning high paid employees, they lose much more. So we look at, very simply within firm, top 1/3, middle and bottom 1/3. As you can see, the losses are about, twice bigger compared to the bottom at the top 1/3, and middle is just medium, right? It's close to the average effect. So that heterogeneity is very, very clear. High earning workers before the treatment, they tend to lose much more than bottom paid workers. Now, what about some other measures of, potentially high human capital or high earning kind of covariates? So when you look at, college educated versus no college educated workers, obviously the losses are concentrated among college educated workers, and male versus female. Typically, males are earning more. There's a gender pay gap, and male workers are losing more in terms of the economic magnitude. So it kind of goes well with the previous result that the higher you paid before the event treatment, then you tend to lose even more after the treatment. And an extreme version of that is when we look at, okay, what about the CEO and then top 5 executives? And then they are the ones that lose the most in terms of the earnings. So this is the rank and file. Basically, these are every employee other than top 5 well-paid employees within the firm. And this is very close to the baseline, which is about negative 0.1. But then once you go to top 5, it becomes 4 times bigger, negative 0.4. But then to CEO, that's about negative 0.6. So that's one of the starkest results in our paper, showing that the higher you paid, the more you lose as a percentage of your previous annual income, right? So this is not, I'm not talking about dollar magnitude. This is a really relative proportional losses that is bigger for the higher paid employees, right? So these are all interesting, I think, but toward the end of my talk, in the next few minutes, I'll talk about, okay, what does it mean for the mechanisms of these earnings losses that we document. And this is just a quick slide on, we do the same pre-trend test now for all these different groups, rank and file, top 5 CEO, and then we don't see any evidence of strong pre-trend, so which is good. Now, we do a little bit of heterogeneity analysis. I'll be quick on this, but very quickly, we look at, firm stayers who stay at the firm post-events by, T+3, 3 years after the treatment and control setup. And you can see, most of the losses are really concentrated among the firm stayers and also leavers to non-employment. So without going into detail, this is kind of consistent with the idea that, losses are coming somehow within the firm, right? As opposed to, those who leave the firm and then go to the next job. There's almost no loss for those type of workers. So I just wanted to emphasize that, and that matters for our interpretation later on. I'll skip this in the interest of time. And this is just a way of showing that the size of the effect is actually an increasing function of the treatment size, meaning, in our baseline, we use that 5% threshold, and then that's what's in these blue dots with the standard error bars. But as we increase, okay, let's increase the treatment threshold to 10%, right? Meaning at least 10% increase in block institutional ownership, then all the losses by group are something like 1.5 times or even twice bigger. So that goes well with the, bigger concentration, bigger negative effects on workers' earnings. And we go even extreme by, okay, let's make the threshold 2 standard deviation positive, and that gives the greatest impact on all sorts of employees. So it's a one way to show that, okay, the size of the effects is a function of the size of the treatment. And we thought this is a pretty important result, and then I'll hopefully go into the mechanism, a couple slides, and then I'll wrap up. So you may wonder, okay, are we talking about investors like BlackRock, Vanguard, who run Russell 2000, S&P 500 index fund? Because you can imagine those are pretty passive investors, and it's kind of hard to imagine their investment, even though they're kind of concentrated at a given firm level, has any impact on workers' earnings. So we kind of basically test the hypothesis by classifying institutional investors into indexers, blue bar, where you see relatively little effect. Basically at the baseline level, there's no significant impact. And transients are similar, but they're kind of following the returns, chasing returns, and we don't see much effect. And where we see the effects, negative effect on earnings, is really dedicated institutions who tend to have relatively small number of stocks, so their portfolio is very concentrated. So they are more likely to have incentive to intervene with the firm's management. So that's really where baseline earnings losses are concentrated, and the CEO and top 5 officers' earnings losses are the greatest. So which makes a lot of sense, right? So these are kind of quasi activist investors where they actually pay attention to the firm and they invest in, and they probably pay attention to the workers of the firms they invested. Okay. Now, let me just spend a couple minutes on mechanisms. I mean, we see, this significant about 10% of previous annual earnings decline as a result of concentration increase and also some heterogeneity. So how should we think about what's going on more conceptually? So here's kind of, more tentative, but one way to think about and interpret the results. So one way is, typical classical rent sharing. So imagine workers and firms are just Nash bargaining with the, the productivity P minus B workers outside option. That's what we typically call, labor economists call rents. So the rents are to be shared by this beta coefficient. You can call it, bargaining power or bargaining weight of the workers. So the higher bargaining power, workers get higher wages, and the higher productivity, and they have higher wages. So one way to think about our empirical results baseline especially is that, shareholder power increase the firm or shareholders bargaining power, which means the beta, which is the bargaining weight of the workers, relatively goes down. And in this type of classical setup, beta goes down, so workers' wage just goes down. So that's an average effect or baseline. But what about the heterogeneity? So one has to assume to explain the, the larger loss when you're highly paid before the event, before the treatment, you kind of have to assume that this rent, P minus B, in a relative scale, right, compared to like your annual earnings, was bigger for higher earning workers to begin with, including managers and officers, right? So one argument, economic argument, might be that, those are the ones who have more specialized or skills so that their labor market is more frictional, meaning their rent, the difference between current productivity and your outside option is bigger. So once there's basically more room for the shareholders to intervene and reduce those rents to those high earning workers. So that's one relatively simple way to think about our results. And the other way, which I'll spend, relatively short amount of time is, especially for rank and file employees, you can also interpret this as some kind of inward shift in firms' labor demand. So I'll be kind of brief here, but hopefully the idea is intuitive. So imagine, very frictionless, meaning the labor market is perfectly competitive. So that means firm level labor supply is just completely flat. And perhaps one way to think about increasing concentration of institutional ownership is that this demand curve for labor, right, this wage and firm level labor is shifting inward. Why? For example, managers wanted to have bigger workforce, but now they are pressured by concentrated institutional ownership, so they have to tame down their preferences. So they'll shift down the labor demand curve from D to D prime. And in this competitive labor market, there is no impact on prices, which is wages, right? While the basically number of people, workforce, employment will go down significantly. And that seems to be very consistent with our result that, for let's say bottom 1/3 of the workers, there's no impact on whatsoever on earnings or wages as a proxy. But then if you look at more frictional labor market, basically the labor supply curve is now upward sloping. So long story short, the demand curve same, inward shifting due to increased concentrated ownership now has an impact both on wages, that's the price, goes down, and then your number of employees also goes down. And that seems to be going well with our, results for top 1/3, or generally speaking, high human capital / high pay workers, because they're the ones where there is a significant drop in earnings, right? So that's one way to think about, so perhaps the high paid workers, their labor market is more frictional in that there's it's hard to move between jobs, while, low paid employees, let's say janitors and etc., typists, maybe, their labor market is very, very flexible in that workers can move between jobs without much cost. So seems to be consistent. And just the last one figure from the other paper with Antonio and Thiel. So I talked about this decline in L star, the number of employees as a equilibrium labor demand. Actually, the other paper using the census LBD data, we actually show that relatively similar treatment leads to significant about 2 to 3% decline in establishment level, business establishment level employment. So that goes well with the decline in L star. So it seems that combining these two papers, we find evidence consistent with the demand curve at the firm level for labor shifting inward. Okay, let me wrap up. The key result is that, there's about treatment involves 13 percentage point increase in block institutional ownership. That's increasing concentration. We find, rank and file about 10% decline in earnings, and for CEOs, it's about 60%, so 5 to 6 times bigger over the next 6 years. So it's a pretty big magnitude. So in terms of policy implication, we're careful here because, we're scientists, economists, so we're trying to document things, but still, we believe these results have pretty important implication for the view about firms as maximizing shareholder value versus stakeholder value type of thing. Because, what we show is essentially when shareholders are getting stronger, it's getting closer to the shareholder view compared to the stakeholder view, right? And lastly, our heterogeneity result for the top 5 officers and CEOs, that I believe shows that those employees and workers labor market is much more frictional. So there is a bigger range to begin with. So then once strong shareholders come in, they basically have more to lose, and that seems to be consistent with our heterogeneity results. That's all I have, and thanks for your attention. I look forward to Q&A.
Fantastic. Thank you so much, Dr. Kim. I really appreciate it. That was a great presentation.
Thank you.
If you and the folks in the chat agree, so if there are any questions, go ahead and please type them into the chat. I fear you are so thorough that you've answered everything.
I hope not.
But we'll give it just a minute. I will say I'll ask one question about your work in the RDC. One of the things that we've talked about in the presentation series is kind of a nuts and bolts about working in the RDC and going from a non-RDC worker to now you're fairly regular from what I understand.
Mm-hmm.
What is a piece of advice that you give to new RDC researchers, those who haven't been or who are just starting RDC research?
Yeah. I think, I mean, very short answer will be plan ahead, in that you lose that flexibility of, analyzing your data on your laptop, right? You
Right.
have, let's say, 4 or 5 years of time frame, and then you have to be in a secure place. And most of all these results have been, thoroughly disclosed, which takes time and effort and some almost strategic planning. So I think the good thing about it is that even though it's costly for sure for researchers, especially if you're a tenure track or something, but it actually gives you more discipline because you're not gonna just disclose millions of different coefficients. So you actually have to think about your entire paper almost as you analyze the data and especially submit for disclosure. So in that sense, I mean, some of my colleagues ask me, "Oh, isn't it too costly?" But I say, "Yeah, it's kind of, but at the same time, it gives me like a good discipline." So at the end, your product is almost ready at the point of disclosure, which I
Yeah.
think is a little bit of good thing. Yeah.
Yeah.
Yep.
That's a great thought. Okay, we will give it a couple minutes if there are any questions, and if you have a question that arises later on, you can reach out to Dr. Kim directly.
Of
As a
course. Yeah.
reminder, the presentation will be made available on the U.S. Census Academy website, and you can see this presentation as well as all other FSRDC presentation series presentations on that site. And you know what? It looks like I said, I think you've answered everything. I'm not seeing a lot of questions pop up, but I do
Okay.
want to thank you. Thank you so much for taking the time. The presentation was phenomenal, very thorough. Please reach out if you have any questions to the panelists, those who are attending.
Mm-hmm.
Again, if someone would like to present their research at the FSRDC presentation series, please reach out to me. But we will go ahead and call today. Dr. Kim, again, thank you so much.